For our non-traditional investors looking for opportunities, we might have the fund for you. Emma Davidson from Global Value Fund joins me now. Emma, thanks so much for coming in and joining the Wealthy Effect.
Thank you so much for having me. It's a real pleasure.
Okay, we've just been having a fabulous chat off camera about your history, and whilst we can't share that, you can certainly share what the Global Value Fund is, and just give us a rundown.
Absolutely, yeah, sure, no problem. So the Global Value Fund is an investment company that's listed on the Australian Stock Exchange under the ticker GVF. GVF is a boutique fund manager, and we're a little bit different. We're not your traditional fund manager that kind of goes around and picks stocks on your behalf. Rather, we're looking for a very, very specific type of investment. In Australia, the types of investments that we're looking for are called listed investment companies or listed investment trusts, but all over the world they have different names.
Yeah.
Essentially, they are these closed pools of capital, and they have the ability to trade at a discount, as we were discussing. So, we'll look for the company will invest into assets. Those assets will make up the value of the company. But if you or I actually want to go and buy those companies, we need to do so on the exchange. And it's when those shares maybe trade below the asset backing that we start to get excited.
Okay, so let's give an example, because that's usually a good way to flesh it out.
Yes.
So viewers understand.
Yeah,
so
absolutely.
AFIC is a really famous one here in Australia and is possibly a good example of what you're referring to.
Yeah, absolutely. No, great one. So AFIC is indeed a listed investment company. AFIC fund managers go out, they decide what they think the best Australian companies are going to be. They buy those Australian companies, they hold them in their portfolio, and that forms the asset base of what they're doing. Let's say theoretically that the AFIC assets on the balance sheet are worth $10 a share. Mm-hmm. Let's also say that AFIC on the stock exchange is trading at $9 a share. So there's a discount there, a 10% discount. Let's make a further assumption that we at the Global Value Fund know of a catalyst or some sort of mechanism that is going to take that share price from $9 back to the $10.
Basically to the NTA, the
exactly.
NAV. Yeah.
Exactly. So we know that in those scenarios where we've got a discount and we know of a catalyst, we will go buy the shares at $9, get those shares back to $10, and we'll realize two sources of returns for our investors. First, there'll be the returns that come from AFIC's portfolio of Australian companies, but secondly, there'll be the returns that we make, the 11% we make from $9 to $10.
Yeah, so basically you get the uplift as the discount to the NAV closes out.
Exactly.
Yeah, and it's really important for people to understand with these listed investment companies, listed investment trusts, they're not like unit trusts,
no.
Which you when you go and buy those, there's new shares issued, and it trades, doesn't it, more around the NAV?
Absolutely.
As you said, it's a closed pool.
Exactly.
And because of that, because of market sentiment, because of the way investors work, you can sometimes get these very big investment trusts trading at these great discounts.
Indeed.
And that, if I've understood you correctly, is what you're capitalizing upon.
Exactly. It's about $500 billion US worth of kind of assets around the world. It's all kinds of different asset classes as well. So obviously we talked about AFIC with Australian shares, but there's also global shares, there's global bonds, there's real estate, there's private equity, hedge funds, student accommodation. The underlying assets that you can purchase all around the world is absolutely huge. And I think, what we try to do at the Global Value Fund is we try to buy a little bit of everything. So we have a very diversified portfolio of underlying assets. So we might have, AFIC might form 5% of our portfolio, but then we need 20 to 30 other sort of positions similar.
Yeah.
And what we're doing is we're creating a very diversified underlying portfolio of assets, which you and I both know, when something's very diversified, it's lower risk. When something's lower risk, it should be lower return. But the way that we are achieving those, well, I think very respectable returns is we're strapping on top the discounts that we are unlocking doing what we do around the world.
Okay, so many questions springing to mind, so I'm going to have to discipline myself here.
Okay.
When you go and make the selections for those equivalent investment companies, investment trusts around the globe, is it like, how do you scan? Do you say like sectorially a top-down approach? Let's give you an example at the moment. Commercial property really bombed out. Everybody thinks the you know, we're going to have a lot of wipeouts there, and I wouldn't be surprised with some of those investment companies in that specific sector. You could argue that some of the discounts to NAB become quite heavy.
Huge,
So is that the type of approach, or do you take it a different way where you scan for those discounts and then analyse the company or trust? Great
question. Wow. Okay, so what I would say as the absolute starting point, first of all, it's a reasonably small market. $500 billion US is not a huge amount. And we do have heavy systems that we've developed over the last 2.5 decades.
So quant
systems, exactly. So we scan, but we're looking for two things really. We're looking for a discount, not necessarily the quantum of the discount, but discount number one. And we're looking for a catalyst, number two. The underlying story is interesting to us, and it's absolutely essential in terms of that diversification, but it will be something that we look at secondary, if I'm honest, because we're going to look at what is the company, what is the discount, can we get that discount out? That really is what motivates us.
What are catalysts for the discount to NAV closeout? One of them might be, let's say, an activist investor that asks for the fund to be wound up. That's a classic one that springs to mind.
Easy one,
What are some of the other ones?
Yeah, absolutely. So, you know, the market is a lot bigger than in Australia. Globally, it's huge. And in a lot of the markets, for example, in the UK or the US, written into the constitution or indeed the offering memorandums of a lot of these kind of companies are discount control mechanisms. So mechanisms that we can essentially arbitrage and we can essentially partake in. It means that we kind of have two parts to our strategy. We have the trading book, which is all this kind of arbitraging and making sure we get that bread and butter, you know, constantly turning over the portfolio. And then of course on the other side there is the activism side where, you know, if all else fails, unfortunately sometimes these things need to be wound up.
Yeah, and fascinating. Now, in terms of the return, we've discussed that pickup as the discounts closed out, but in Australia, a lot of these investment trust companies, they pay beautiful dividends. So I assume you're going to have the pass on of the dividend as well. So when you look at the total return that you provide to investors, does it have a yield component as well as a capital return?
Great point. So for us, you know, we've been going almost 10 years in July. We've annualized at 10% per annum after all fees and expenses. And I'm really chuffed to say that we haven't actually had a down year, which
Congratulations.
I think, thank you. It kind of speaks to that capital preservation and the fact that we are so kind of risk obsessed. But in terms of the yield is really important in our particular field, especially for the self-managed super fund world that we kind of cater toward. And the yield that we pay, you know, is 8.5% to 9% per annum.
Not fully franked, I assume?
It's all, that's gross. That's a grossed up yield. Yeah, absolutely. It's 3.3 cents per semi-annual, so about 10 cents per annum grossed up. We tend to pay the majority of what we make out to our shareholders, but there has been a little bit of shareholder, you know, a little bit of appreciation on the share price as well, but not a huge amount. Again, we aim to be an income fund.
Okay, so it's basically an income fund. And what is your structure, just so everybody, we've been discussing all the structures you invest in, but what is the structure of the Global Value Fund?
Well, that's actually the irony of it all. So we are indeed a listed investment company.
I was about to say, you probably are.
Exactly. So we kind of, you know, we drink our own cooking, we eat our own cooking rather. We are a listed investment company ourselves. We think that they're excellent vehicles if you've got the strategy that suits. We're listed on the ASX, and we're a closed pool of capital as well. So traditionally always traded very close to our asset backing, which is great. But yeah, we're a LIC as well.
Oh, isn't that absolutely fascinating? So Emma, I guess the question is because it is a closed pool of capital, are you ever in a position, can you have an issue and expand that, or would you be looking to grow the size of the Global Value Fund?
Yeah. You know, funnily enough, with regards to the Global Value Fund, we have actually taken the view of keeping ourselves quite small. We're 200 million now, and I don't see GVF ever getting bigger than 300 million. And the main reason for that is we target very high alpha returns, and we want to wake up every day being really excited about that $500 billion of market and be spoilt for choice, right, in terms of what we trade. In terms of us growing the vehicle, you know, it happens when we trade at a premium. We would only ever be able to issue when we trade at a premium. At the moment, we're trading on a small little discount. So, you know, if the stars aligned and we did maybe get to a premium for a period of time, we could consider it for sure, but it's not a huge priority for us.
Okay, fair enough. So just to wrap up, Emma, so basically you've had a 10% return on average over the last 10 years, and essentially it's a yield fund, just so people understand.
Exactly.
Fantastic. Congratulations.
Thank you.
Well, I love to see female entrepreneurs
thanks for having
in
us.
the finance space. So thank you so much for joining the Wealthy Effect.
Thank you. Thank you, Danny.